There is a version of financial responsibility that looks exactly right from the outside and quietly costs you everything on the inside. It is the version where you are disciplined enough to save money every single month, consistent enough to never miss a contribution, and careful enough to never spend recklessly. And yet 10 years later, you have almost nothing to show for it because every dollar you saved was sitting in an account earning less than inflation while the market compounded without you. Saving without investing is discipline without a destination. And in 2027, with high-yield savings rates beginning to compress again and the market offering real long-term return opportunities, the cost of staying in savings rather than moving into investments has never been clearer or more urgent to address. My name is Thomas, and this channel is about finance, automation, and closing the gap between good intentions and real outcomes. If you are new here, welcome. Hit that like button right now and subscribe so you never miss a video. Today, we are going through the step-by-step 2027 guide to turning saving into investing. The exact moves, in the exact order, built for right now. Let's get into it. Let us move through this in clear sequential steps, because the order is not arbitrary. Each step creates the foundation that makes the next one work. Step 1. Draw a clear line between savings that must stay liquid and capital that is ready to invest. The most common mistake people make in the transition from saving to investing is treating all their savings as a single pool of money. They look at the total balance, feel uncertain about how much of it they can afford to lose access to, and decide the safest option is to leave all of it exactly where it is. This indecision costs years of compound growth. The correct approach is a clean separation. Your emergency fund, 3 to 6 months of essential living expenses, stays in a high-yield savings account. Liquid, accessible, earning whatever rate is available. In 2027, those rates have begun compressing from their recent peaks but still meaningfully outperform traditional savings accounts. This money does not get invested. It is not a portfolio. It is a financial floor. Every dollar above that floor is capital available for investment, not eventually. Now. The moment you can draw that line and name the exact amount sitting above the emergency threshold, the transition from saving to investing has already begun. Everything after this step is execution. Step 2. Choose the right account before choosing any investment. In 2027, the account type is not a bureaucratic detail. It is the decision that determines how your investment returns are taxed. And tax drag on a long-term portfolio is one of the most significant costs most investors never see or measure. The account sequence for most investors is consistent regardless of income level. If your employer offers a retirement account with a match, a 401k or equivalent, your first contribution goes there, up to the full match amount. The employer match is a guaranteed 100% return before the market does anything. It is the single highest return investment decision available to any investor. It always comes first. After the match is captured, the Roth IRA is the right next account for most investors transitioning from savings in 2027. In the current interest rate and tax environment, the case for paying taxes now on contributions and accessing all future growth completely tax-free is strong for anyone not currently in the top income brackets. A Roth IRA opened at any major brokerage, Fidelity, Vanguard, Schwab, takes under 30 minutes, has no account minimum at most providers, and can be funded with an automatic monthly transfer set up on the same day the account opens. Once the Roth IRA is fully funded each year, surplus investment capital goes into a taxable brokerage account. No contribution limits, no access restrictions, full flexibility. The tax-advantaged accounts first, always. Taxable second. Step 3. Buy the simplest, lowest cost investment available and automate the contribution. With the right account open, the investment selection in 2027 for someone making the transition from savings is not complicated and should not be treated as complicated. One low-cost index fund, a total U.S. stock market fund, or an S&P 500 fund, is the starting investment for the majority of investors making this transition. The reason simplicity is not a compromise, but an advantage comes down to 3 things. First, the historical performance of broad market index funds after fees consistently matches or exceeds the majority of more complex alternatives. Second, the low expense ratio, often below 0.05% annually, means almost no cost drag eating into the returns. Third, the psychological simplicity of owning one fund with one investment thesis. The long-term growth of the global economy makes it dramatically easier to hold through market downturns without panic selling. The automation of the monthly contribution is what makes the transition permanent rather than temporary. Set up a recurring transfer from the checking account to the investment account on payday. The transfer happens before the money can be mentally allocated to spending. The investment occurs without a decision being required each month, and the habit compounds alongside the portfolio, both growing quietly in the background without requiring ongoing attention or willpower to sustain. Step 4. Reframe how you think about market drops from this point forward. The final step is not a financial action. It is a mental model that must be in place before the first investment is made, because without it, the transition from saving to investing will reverse itself the first time the market corrects. In a savings account, the balance never drops. The number only moves in one direction. Investing introduces the experience of watching a balance decrease, sometimes significantly, in a short period of time. For someone coming from the psychological safety of a savings account, this experience can be genuinely alarming in a way that feels like evidence that investing was a mistake. It is not. A market drop is not a loss until it is locked in by selling. An investor who holds through a 30% decline and continues making monthly contributions is buying additional units of the same index fund at a 30% discount. When the market recovers, and the complete historical record shows it always has, those additional units purchased during the decline generate returns proportional to the full recovery. The person who stayed invested and kept contributing through the downturn ends up with more units at a lower average cost than the person who stopped or sold. That mathematical outcome is the reward for the psychological discomfort of watching the balance fall without reacting. Understanding this before the first drop happens is what makes the transition from saving to investing durable. Not just for one market cycle, for every one that follows. So there is the complete step-by-step 2027 guide to turning saving into investing. Draw the line between your emergency fund floor and your investable capital, and name the exact dollar amount sitting above it. Choose the right account in the right order. Employer match first, Roth IRA second, taxable brokerage third. Buy one low-cost index fund and automate the monthly contribution so the behavior is structural rather than dependent on motivation. And build the mental model that treats market drops as discount windows rather than warning signs before the first drop arrives. Saving got you the discipline. Investing is what turns that discipline into something that actually compounds. The line between saving and investing is not a complicated financial concept. It is a decision. Make it today. If this video finally moved you from thinking about investing to actually doing it, please hit that like button. It genuinely helps this channel grow. And if you are not subscribed yet, click that button right now so you never miss what is coming next. See you in the next one.